As tensions mount, China is warning its trade partners not to cave under pressure in tariff negotiations with the U.S. China's Commerce Ministry saying if any countries agree to deals that would hurt Beijing's interests, they will, quote, resolutely take countermeasures in a reciprocal manner. Joining us now with more, Scott Kennedy, the Senior Advisor and Trustee Chair in Chinese Business and Economics at the Center for Strategic and International Studies. Scott, great to have you here this morning. The president awaiting a phone call from Xi Jinping. I'm curious, how likely is it, in your view, that we see blinks from China before the U.S.?
I think the chances of that are pretty low for China to blink first. I do think that we'll see both sides talk to each other soon. Already at the staff level, there have been communications. I don't think we're going to see President Trump and Xi speak directly in the next few weeks because the U.S. is focused primarily right now on trying to reach trade deals with other countries, partly as a way to make China feel more isolated. But China, as they say, is in this to the end because this isn't just a trade spat now in which they could just negotiate a few market access agreements and purchases to make this go away. This really gets to the heart of the Communist Party's hold on power. Xi Jinping has to look like he's defending Chinese interests. And they have a bunch of staying power. China's got a lot of fiscal space. They've got better tech than they had before. They do have strong relations with a lot of other countries. And so I expect them to stick with this for quite some time.
So then where do you see this heading? Obviously, you mentioned that you expect China to stick with this for a long time. There have been sort of sectoral negotiations, at least from the White House, talking about a reprieve for some of the automakers, maybe for some of the individual tech companies as well. How do you see that playing out?
Yeah, there are a variety of areas where this could escalate into finance. For example, if the U.S. decides to kick those 286 Chinese companies that are listed on American securities markets off them, pull the licenses of Chinese banks, the Chinese could do the same with American financial institutions in China. You could see a variety of different ways that this could escalate. But I think over time, the two economies are going to feel the pain, particularly in the United States, because of our very large financial markets. The U.S. already backed off the Liberation Day tariffs against others. They've made exceptions to IT products from China. So I expect at some point the U.S. is definitely going to want to settle with China, and the Chinese are going to want a deal as well. Is that going to be a deal that really solves the real challenges we have from Chinese state intervention in their economy?
Yeah.
No. But will we get to a more stable place than we are right now? I think at some point we will.
And Scott, my guest host, Ann Berry's got a question for you, Ann.
Scott, where do you think, even when the tariff noise dies down, from a regulatory perspective, where do you think some of this sticks, whether it's a limit on the number of chips that can be exported to China, whether it's things like TikTok and where that lands? What do you think are going to be the longer-term consequences here?
Well, I think the economic security restrictions that the U.S. has been imposing on China over the last 7 to 8 years, that train has left the station, and those are going to continue to be escalated. The Biden administration called that small yard high fence and focused primarily on advanced semiconductors and semiconductor equipment. The Trump administration has continued to expand those restrictions also into less advanced chips, legacy chips that don't need that are used quite broadly, but aren't is used in military applications as much. But we're going to see that in the automobile sector, restrictions for data security and others. So I think the tech restrictions are going to continue to expand regardless of where this trade spat turns out.
But how much power does China have to really ding the U.S. large cap tech names?
China is a monster market for many American companies, and they can impose a lot of pain if they choose to. I don't think they want to. They want those companies' investments and partnerships in China and in third markets. But if they decided to, they could make life much more difficult for Tesla in China, for Apple, for some other companies. They've already launched investigations into Google, into DuPont. Yet China doesn't have the direct level of leverage that the U.S. does, but it can pose pain. I think the main way the Chinese can hurt the U.S. is by fighting back in general, looking like they have staying power, which makes American financial markets less stable. And we've seen that over the past few weeks. I think that's their main strategy, to try to get the U.S. to want to get to a deal.
Scott, in our final minute, just curious what you think about the push from the Trump administration to look into ways to potentially fire the Fed chair. Obviously, legal battle to come on that, but how does that sort of noise happening stateside impact the tit for tat with China?
Well, if the president was able to do that and he got a Fed chair that was more amenable, that person may be able to lower interest rates or do other things that try and boost the short-term prospects of the American economy and make the U.S. have more staying power. On the other hand, it might inject a lot more uncertainty in which markets would react negatively. As we've seen, market reaction is central to how the Trump administration judges their own staying power in this. So I'm not sure that changing the Fed chair actually makes the U.S. position relative to China that much stronger. It might actually weaken it.